Today at the National Press Club, the chair of ASIC, the Australian Securities and Investments Commission, Joe Longo. Mr Longo will discuss the shifting landscape of Australia's economy and how we can take charge of the future of our financial markets. Joe Longo with today's National Press Club address.
Hello and welcome to the National Press Club and today's Westpac address. My name's Tom Connell. I'm the president here at the club and also a host at Sky News Australia. Our guest today is the chair of ASIC, Joe Longo. I was debating whether to say outgoing, because he is outgoing technically, but he's here until May. But I feel as though outgoing gives you licence to be honest, so I'll say the outgoing chair of ASIC, Joe Longo. His topic today, open for opportunity, taking charge of the future of our financial markets. Australia's financial markets, of course, evolving around with the rest of the world. Private markets no longer the preserve of institutions, public markets dwindling and no longer the default destination for capital. On an individual basis, it's never been easier, of course, to take charge of investing, for better or for worse. You can change your entire super investment in 5 minutes, set up an ETF investment linked to every purchase you make on your debit card, or put your life savings in crypto and hodl, as the kids say. None of this is financial advice, by the way. As markets are transformed, Australia needs to stay at the forefront, but there's an argument, so does regulation. When computer-based trading took off in the US, one small broker in New York revolutionised trading for everyday traders by being able to make it commission-free. So a win for the little guys. It's worth noting that small broker was Bernie Madoff. Joe Longo commenced as ASIC Chair on June 1, 2021 and is set to leave the Commission, as I mentioned, in May. He's held senior leadership roles for 4 decades in corporate law, financial services, regulation and law enforcement as well. Please join me and welcome ASIC Chair Joe Longo.
Thank you, Tom, and thank you all for being here today. I would like to begin by acknowledging the Ngunnawal and Ngambri peoples, the first custodians of this region, and pay my respects to elders past and present. I extend that respect to Aboriginal and Torres Strait Islander people who may be present here today. Like almost half of all Australians, I'm the child of immigrants. My parents came to Australia from Italy after the Second World War. They met in Sydney and shortly after marrying decided to move back to Italy. But when they got to Perth, they ran out of money. So they set up shop there instead. And I mean literally set up shop. I spent much of my childhood in the back of my parents' greengrocer shop. Later, my mother, who was missing Italy terribly, wanted to move back. But my father was adamant that the children's future was in Australia. Why? Because Australia was and is the land of opportunity. That's the Australian promise. Opportunity and a better life for the next generation. And it's a promise for a long time Australia has delivered on. But I'm here today with a warning. Australia must innovate or stagnate. Seize the opportunity or be left behind. Right now, Australia faces a choice about the future of our markets. The world is changing and our markets need to change with it. We shouldn't be passive recipients of these changes. We should be ambitious and seize opportunities. And we should put the foundations in place today to ensure we will have the future that we want. Before I talk about what's ahead, though, it's worth taking stock of where we are now. Over the past decade, there have been significant structural changes in our markets. The first is the rise of Australian private capital. This sector is still relatively small when compared to our $3.3 trillion listed equity markets, but it's growing rapidly. According to one estimate, the private credit sector has grown 500% over the past 10 years to more than $2 billion. This rapid growth in private markets is a global phenomenon with a local protagonist. In the past decade, our superannuation system has grown to more than $4.3 trillion, outpacing growth in both GDP and our public markets, and has become a structural driving force in developing private markets. Superannuation trustees play a key role in enabling retail investment in private markets. For most Australians, the main road into those markets currently runs through their super fund. Which brings me to my first key point. The growth of private markets has been fundamentally good for the Australian economy. Private credit in particular has emerged as an important source of funding for sectors that are currently underserved by the traditional banking sector and provides more diversification and choice for borrowers and investors alike. But while this growth is helping fill gaps, we can't forget public markets are also critical to Australia's economy. And with the growth of private markets, we're seeing structural changes to public markets, both here and around the world. In the past decade, the market capitalisation of the ASX has nearly doubled, yet the actual number of listed companies has declined. The top 20 companies on the ASX account for more than half of market capitalisation, making Australia one of the most concentrated markets in the world. At the same time, the value of equity raised in initial public offerings in Australia has declined by more than 80%, from $22.9 billion in 2014 to just $4.2 billion in 2024. Of course, the important role for public markets remains, and ASIC is committed to doing what we can to make them as attractive and accessible as possible. However, what we've seen is that the rapid growth of private capital in the economy is actually enabling companies to stay private for longer. In other words, companies don't need to go public to grow anymore. And with new platforms like FCX entering the Australian market, new bridges are being built between public and private markets. In the past, we've tended to talk about public and private markets as if they were totally separate. But what our work is showing is a convergence, a shift from public or private to a single concept, the concept of the market, a shift that will only accelerate with new technology. Technology developments over the next decade and beyond will make our current investing landscape appear as antiquated as the trading floors of the 1980s. Distributed ledger technology that facilitates asset tokenisation could fundamentally transform our capital markets in the same way as the introduction of chess once did. Historically, investing in certain asset classes like private equity and fixed income was reserved for institutional players or high net worth individuals. Tokenisation changes this by making it easier for assets to be broken into smaller, more affordable units and traded quickly and securely on a global scale. And it allows new players to offer financial market services and challenge the status quo. This isn't some far-off future I'm talking about. JP Morgan have told me their money market funds will be entirely tokenised within the next 2 years. That means their investors will keep earning while value is moving instantly. Compare that to current technology where it takes days for transactions to settle. And they aren't alone. Subject to regulatory approval, NASDAQ has proposed launching tokenised securities trading 24 hours a day, 5 days a week by late next year. The American financial market infrastructure giant, DTCC, has also proposed its own tokenised platform. And if assets and money exist on the same ledger, we could one day see atomic settlement, simultaneous post-trade swapping of cash for an asset. Add quantum computing to the mix, and this process could become even faster. On top of that, imagine what impact artificial intelligence could have on executing lightning-fast transactions. Once, Australia was one of the early adopters of innovation in markets. We were an early pioneer of electronic trading. ASIC Chair was innovative in its day, back in 1994. And the first tokenised bond from the World Bank was issued in Sydney in 2018, the aptly named Bondi. Now, other countries are outpacing us. Switzerland's SIX digital exchange, operated by the Swiss equivalent of the ASX, launched its first digital bond issuance in 2021 and has already surpassed $3.1 billion US. And in the United Kingdom, firms are exploring tokenisation through the Digital Securities Sandbox, operated by the Bank of England and the Financial Conduct Authority. I spent some time last month with the chair of the US Securities and Exchange Commission, Mr. Paul Atkins. And what really struck me in my discussion with him was that Australia is facing the same challenges as other countries and is competing for the same capital. That other countries are actively courting this capital, and we need to as well. To my mind, it means we have a window of opportunity now. while so many jurisdictions are facing the same challenges to seize a larger slice of this opportunity. But as other countries adapt and innovate, there's a real risk Australia could become the land of missed opportunity or be passive recipients of developments overseas. If that occurs, the changes in our markets may not be for the better. Even though the growth in private markets is a fundamental good, we still have challenges to address. For example, lower levels of transparency compared to international standards. Compare this sector to the public market, where people trade from a position of knowledge because of continuous disclosure obligations. This isn't the case for transfers of value in controlled private market matters, and that brings risk. In a private market, there's also lack of clarity around funds' fee structures. Add to this the fact that the Australian private credit sector at its current levels is untested under market stress scenarios. With a large proportion of illiquid investments in high-risk real estate developments, we have a good reason to be critically thinking about this. That risk is amplified when we remember that private equity and credit are now firmly established as asset classes in superannuation and will continue to grow along with the rest of the superannuation pie. While it's true that as a rule, super funds tend to have a stabilising effect on markets during times of stress, the sheer size of super means we need to start thinking about it differently. A severe and unexpected liquidity shock could cause super funds to raise liquidity in ways that increase financial market stress. And historically, superannuation hasn't had the same scrutiny as other institutions that are systemically important, such as the banks, although that is changing. We've already seen missteps and failures in the private credit industry as a result of the wide variance in practices across the sector. In recent weeks, we've pulled up La Trobe Financial and True Pillars Investment Trust for issues in how they are offering their products. We've seen high-profile collapses in the United States with First Brands and Tricolor, and warnings of cockroaches and contagion. And the Bank of England Governor, Andrew Bailey, has said the whole situation reminds him of how the global financial crisis started. If we fail to address the risks building in this sector, we could very well see our own Minsky moment in Australia with a market collapse. In times of prosperity, when money flows freely, no one worries about liquidity. However, it's the first thing everyone will miss in a crisis. So while the sector is still small, we have time to act, and that requires us to make some conscious choices. After all, risk done well is opportunity. And if we manage these risks well, there will be more diversification, more competition, and more opportunity for all. So how do we do risk well? The answer is by acting now to build the guardrails and the foundations that enable greater strength and integrity in our markets. That is why ASIC started our work on evolving capital markets in the first place. The consultation we've been doing since our discussion paper in February has been about ensuring Australia stays competitive so that our markets remain open, efficient and attractive to investors, and that we maximise the opportunity before us. The report we've launched today is a blueprint for turning risk into opportunity and a call to action. The report examines how we can invigorate our public markets and keep attracting investors. In addition to our streamlining of the IPO process, we're engaging with industry on amended listing frameworks, new trading platforms, and expanding approved foreign markets for the listing of companies in Australia. One of the overarching themes in our report that we want to strike a better balance that minimises some of the regulatory arbitrage we've heard about in our consultations. We've heard that this is not the only factor. However, it has to be said that it is a factor that is contributing to private companies shying away from IPOs. Ask nearly any public company director in this country and they will tell you their job is getting harder and harder. There are a number of issues at play here, most outside of ASIC's regulatory gift. But as a starting point, I think Australia needs to seriously look at the line we draw between when a company is public and when it's private, and the obligations that flow from that. Some of Australia's largest private companies have very wide indirect retail ownership through superannuation and other vehicles. Canberra is an example. Is it right that companies like that are subject to more limited disclosure obligations than for a much smaller public company? I said earlier that our markets are converging and technology will only accelerate this trend. In light of that, our traditional public and private dichotomy is no longer working. We need to work towards a framework where, instead of drawing lines, we manage a spectrum of risk. As a first step, the proprietary company threshold can and should be adjusted. Under the Corporations Act, a company is considered private only for so long as it has no more than 50 non-employee shareholders. That's a low threshold compared to other jurisdictions and acts as a handbrake on company capital raisings that slows growth. Another area that needs attention is prospectuses. In the past 20 years, prospectuses have more than doubled in length, from an average of 109 pages in 2005 to 266 in 2024. I'm not convinced investors are being served by these lengthier documents. Australia must make some critical decisions in the next few years about how we modernise and strengthen our markets, how we ensure super continues its positive influence, and how the law can better support confidence in future growth. The first decision is how to modernise and strengthen our market structures. ASIC has already begun to ask how to ensure market structures remain fit for purpose through our capital markets work. The inquiry we launched earlier this year into ASX and its ability to maintain market infrastructure is part of this. But these questions aren't ours to answer alone. As markets evolve, market operators, participants and funds must evolve too. This requires fresh thinking and innovative ideas from all participants. There are some disruptors emerging in the Australian market who are doing things differently. Imperium Markets is an example, one of the players who are piloting tokenisation in debt markets as part of Project Acacia, run by the RBA and the Digital Finance Cooperative Research Centre. But we're not seeing enough of this energy and enthusiasm in significant parts of our market. ASIC's recent tokenisation survey was one example of this. Around half the market declined to take part or even meet with us, and only 1/3 provided detailed feedback. Many players in Australia have gotten too comfortable with the status quo. Backing untested innovation means being prepared to take risks. Australia cannot be passive here. We need to be active, to take part and help lead these developments. If that attitude doesn't change, how long before Australians start to do all their trading elsewhere? It's worth pointing out that Australians can already invest in some of the biggest companies in the world through platforms like NASDAQ. It's generally the new players, fintechs, that are driving innovation and may ultimately disrupt traditional finance and market infrastructure. The RBA's Project Acacia is evidence of that, with these innovators leading the way in developing tokenised financial markets and new settlement services. The choice is innovate or stagnate, to evolve or become extinct. Market operators must also ask themselves, are their settings right to compete with these international forces? The ASX recently launched a review of its listing rules. It's a necessary step towards boosting innovation and growth. The work of Dr. Carol Comerton-Ford in another report we released today also shows that we need to rethink how our markets compete globally, from improving listing frameworks and liquidity for smaller companies to embracing mutual recognition and innovative trading models. One area for consideration is whether reporting requirements should be tiered for company size. Why is it that a small cap biotech with less than $10 million in turnover has the same remuneration reporting requirements as our largest mining company, BHP, with a turnover of $80 billion, or have more corporate reporting requirements than the operator of the Sydney Airport, a company with over $2 billion in turnover, which is critical to growth and prosperity, and which millions of Australians are invested in through their superannuation? We need to be asking ourselves, is this really the right balance? How can these rules be more facilitative in enabling smaller players to access capital so they can grow? The next decision we must make is how we leverage the strengths of the public and private sectors to accelerate innovation. A persistent theme I hear from market participants, particularly from my recent meetings in the US and Europe, is that if we want to see innovation, they need to know what is expected of them. This is where I see a role for the public sector, government and regulators, to set the guardrails and the foundations for innovation to thrive. If the public sector can be an enabler, the private sector can be an accelerator. I've spoken often about the scourge of regulatory complexity, and with rapid changes in our markets, we cannot afford to leave it unchecked any longer. The law cannot be static. Innovation starts with a legal framework that can evolve and adapt and that's fit for purpose. That's why I welcome the recent formation of the Corporate Law Reform Alliance and their call to revive a standing expert body similar to the former Corporations and Markets Advisory Committee. I want ASIC to be backers, not blockers of market innovation. Our recent work with the Reserve Bank on Project Acacia is one example of this. This trial has enabled digital money to move swiftly and securely through our economy in many forms. We've also recently accepted an invitation from the Monetary Authority of Singapore to join the Project Guardian initiative, which has been pioneering the use of tokenised funds settling in central bank money. And we've just released our guidance on digital assets to provide regulatory certainty for industry to innovate with confidence. But I think we can and should do more to support innovation from the ground up. So today I can announce that we will review and relaunch the ASIC Innovation Hub, with the focus on seeking out ways ASIC can support financial market innovations in Australia. The Innovation Hub, as many of you will know, was launched a decade ago as a bridge between ASIC and the innovation ecosystem. And while operating, it supported hundreds of fintech and regtech businesses to navigate Australia's regulatory framework. Alongside supporting the government's review of the enhanced regulatory sandbox to better encourage Australia's fintech capability, the first priority of the revitalised hub will be to assess its effectiveness and to do a scan of innovation in financial markets here and abroad to identify regulatory issues and opportunities so that ASIC can be proactive and help Australia seize opportunities. Our hub will have an open door policy. If regulation is an unnecessary hurdle to a new idea, we want to know about it. That doesn't mean just pointing out problems though, but working with us on solutions. Our door is open to all collaborators, government, industry, universities and think tanks. We've already commenced preliminary discussions with the Pawsey Supercomputing Research Centre in Perth and the University of Technology, Sydney, to explore opportunities to further operationalise the large volumes of data and information ASIC receives, and we're open to more partnerships and more ideas. The final decision we must make is how the law can better support confidence in future growth. If Australia is to seize the opportunities I've spoken about, Australians must have confidence in the system. Many of the issues are outside ASIC's regulatory gift. However, recent failures in private markets have exposed weaknesses in our regulatory framework and undermined trust. The private credit sector is a small but increasingly important part of our economy, but it needs to grow from solid foundations. That is why today I'm putting the private credit sector on notice to improve industry practices. We need to see a significant uplift in practices, and if the sector can't get this right, law reform may be required, introducing new mandatory obligations to lift standards and address poor consumer outcomes. But more rules would not be my first choice. If poor practices undermine the integrity of the sector as it grows, we may be left with no other option. There is also work to be done flowing from the recent Shield and First Guardian collapses. There is an opportunity to strengthen the system for all Australians. So I'm repeating ASIC's view of the need to strengthen requirements for managed investment schemes, improve data reporting, and give ASIC the powers we need to oversee this sector effectively. I want to acknowledge the work of the Assistant Treasurer that he's been doing in considering this very important issue. Other ideas should be considered, including disrupting the lead generation businesses that trick consumers into moving their super, slowing down the superannuation switching process, reconsidering the retail wholesale test, and extending the proposed prohibition on unfair trading practices to financial services. We also need to look ahead. One of the fastest growing segments of our superannuation system is platform trustees, with investments up 14.5% in the year to June. One of the key themes of ASIC's work in recent years has been to highlight superannuation trustees' critical responsibilities to members. That's why we keep asking whether trustees are doing enough to meet their obligations, including when things go wrong. This isn't a question for ASIC alone, it's a challenge for all of us. Getting it right will mean greater investor confidence and a more resilient, diversified market. Before I wrap up, I want to acknowledge and thank Commissioner Simone Constant, who's sitting just over there, and our Executive Director of Markets, Calissa Aldridge, who have been absolutely instrumental in ASIC's private and public markets work. Of course, this work has been and will continue to be a whole-of-agency effort from the Commission, who are here today, our CEO, the executive team, and all of ASIC's people. They have my thanks, not just for this, but for all they do to make a difference every day for all Australians. So in conclusion, if we want our capital markets to thrive into the future, the time to act is now. That means finding ways to enhance the attractiveness and competitiveness of public markets so that we can promote sustainable growth. And it means safeguarding transparency and investor protection without stifling innovation or erecting unnecessary barriers to capital formation. So, I'd like to leave you where I started, my family story. My parents and grandparents made very difficult decisions so their children and grandchildren could have the opportunities we have today. And that's a classic immigrant story. You make tough decisions now for the benefit of subsequent generations. Like my parents and grandparents, we have an opportunity to act now, to make a difference for the next generation, to choose our future before it is determined for us. Thank you.
So, talking about the need to innovate, I think you alluded to there the element of regulate along the way. Now, correct me if I'm wrong, it sounds as though you'd be in favour of not going too heavy. Obviously, you need rules in place as technology emerges. But would you be in favour of not having too many regulations to stifle it, even if it means you need to add things along the way? Is that the way to go so you don't stifle?
No, it's more nuanced, Tom. I think we all want innovation. Who's against innovation? The issue is that the legal and regulatory framework needs to provide a good foundation for people to do that confidently. And so that really is about the details, about what's in the legislation, about, well, how do you apply for that licence? What do you need to establish the licence you want to get, and what are the risks that your innovation might raise? The other thing is, from a regulatory perspective, some of the reforms around data and transparency that we're asking for in connection with private credit, if we get that, then that gives everybody more confidence about growing that sector and being innovative there. Because if you know what's going on in a space that's otherwise opaque, then you can be more confident, can't you, about risk-taking. And you won't be surprised by emerging issues because you know what's going on. So to me, there is a role for the public sector and regulation being adjusted and developed in a way that makes innovation welcome, that makes people think, well, if I've got this idea, I know what to do. I'm not going to be breaking the law. And I'm almost certainly going to need a licence, but I'm pretty clear as to what I'm going to have to need or establish to get that licence.
And on the spectrum of obligations you spoke about between private and public, would there be some elements of the private that would have more obligations, even though it's a sliding spectrum, if you like? But do you see the need, when you spoke about transparency there, for some elements?
No, well, I think in the private, there's a lot of work being done on private credit, but as a general proposition, what we think is we've identified poorer practices and better practices in that sector. And so we say there's existing guidance and law that we think we're sort of reminding the private credit sector that they have to comply with. And there are other areas where, and the surveillance report we published this morning goes into the details, where frankly the practices are unattractive. They're not in the interests of investors and they create risk. And so we're calling on industry, and I'm happy to say that we're getting a positive response to say, well, come on, we need you to develop standards that address these issues. That these standards exist in the US, so we're suggesting to the sector you don't have to start with a blank piece of paper. You can get some inspiration from the US and the UK. That doesn't mean, by the way, we're just going to copy what the Americans do or the Brits do, because there are some unique features of our local market. But the key point is that nobody wants more regulation. It's a bit like saying, I like innovation. No one likes more regulation. But that's where this is heading if we're going to protect the public, in the public interest. But I'm optimistic. I think we're getting very constructive feedback from all aspects of industry, and I expect over the next 6 to 12 months to, well, probably won't be me, but there's someone else reporting to the public about progress.
Will you be handing over to your successor some low-hanging fruit from discussions with US or Europe that people say, what are you?
There's no more low-hanging fruit where I work.
No?
Our job, my job, our Commissioner's job is to look for difficult problems and solve them. So there's no low-hanging fruit left from what I could see.
And even though, you know, so many of the changes are about speed and making things happen, you spoke about slowing for super transfers, for example. So that's an example, I suppose, of protections in particular for individuals that you need to be still wary of.
Well, I think that the superannuation switching catastrophe that's been unfolding with First Guardian and Master Shield and related funds, it all started with ordinary Australians, in many cases, moving, my words, their super from a relatively safe, conventional environment into a high-risk environment. And there's plenty of blame to go around for what went wrong there. And one of the things we're suggesting is that we need to slow people down a bit. And so, and that essentially means, and if you go and buy a house or a car or major financial investment, I mean, most of us put some time into that. We don't do it on the same day. And unfortunately, because of the industrialisation of the approach to this misconduct, a lot of Australians were talked into moving their super on the same day or the next day. It's pretty bad.
Is there almost a psychological difference with super? We've seen various scams and frauds on it, where because it's not in people's hands, and if you're in your 40s or 50s, it's a while away, even though it's the biggest investment you have, you sometimes make mistakes of that nature?
The tactics that are being used by people involved in this activity, Australians respond to something they've read online. They're persuaded that they can get a better deal or better return on their super by doing what's been suggested. And so they're literally tricked or persuaded, as I say, to move their money from somewhere safe to somewhere very unsafe. And the people doing this, none of us should think that this isn't going to happen to you, right? The sales tactics are very slick. They're very professional. I've been briefed by my commissioners who are doing most of the work on this. They're sitting over there. That people are kept on the phone for hours at a time, and they're sent documents in real time. So this is a really sophisticated activity that's designed to persuade people to move their money from one place to another. The scam scenario is a bit different. The scams have their own level of badness, but different to what I'm talking about with super.
And that you alluded to one phone call, so there's no opportunity for them to literally talk it over with one other person to have that all occur on the one phone call, and that's the slowdown that you...
Theoretically, there's an opportunity, but the practicality is not. So just going back to the first part of your question, if the system makes it really easy to move your money from one place to another, then once they've got you, it's gone. Once the money's moved, it's very hard for you to reverse your strategy. But ASIC's been doing a lot of work in this area. We've had some success getting our foot on lost investor funds. We have over 40 investigations going on, a number of court cases, and you can expect us to remain very active to do the best we can to hold people accountable for this awful activity.
Go to the floor now, John Keogh from the AFR.
Thanks, Mr. Longo. It's John Keogh from the Australian Financial Review. I'm going to admit to having a bit of assistance with this question, not from artificial intelligence, but from one of my learned colleagues who follows this a little more closely than I do. But you did mention superannuation superannuation trustees in your speech, and then you also touched on the First Guardian and Shield matters there. Is there a future for the outsourced trustee model in superannuation, like we've seen involved in the First Guardian and the Shield matters? Or should all super platforms and funds be required to get and use their own trustee licence, so when things go wrong, we know who is actually responsible? Yeah.
Well, there are two separate issues there. It's up to the superannuation funds and trustees to make their own decisions about whether to insource or outsource critical infrastructure or capability. The responsibility legally never leaves them. In connection with superannuation trustees who run a platform, there's existing law on that, and that's being tested in some court cases at the moment. But I think what we're looking for there is a higher level, or certainly a more serious level of diligence from superannuation trustees as to what platforms or what products they'll permit on their platform. Because they're basically saying to people they're safe to invest in. It's all part of regulated super. So.
Thanks. Jack Quayle from The Australian.
Mr Longo, thank you very much for your address. Jack Quayle from The Australian. I just wanted to ask about your surveillance report across those 28 retail and wholesale funds. It identifies multiple failings across governance, transparency, valuations, credit management. Can you give any indication of whether the Commission will be pursuing any penalties against any of the funds that were surveilled for any potential breaches of the law or falling foul of their obligations?
Yes. Well, there were 28 entities involved. We've already started. The way this works is we, at the end of a surveillance of that kind, we will give entity-specific feedback to each entity. We'll write them a letter usually. And we've already started doing that with some of the bigger entities, and that's a piece of work that we're finishing off. The surveillance process itself, ironically, led to improvements in standards and practices. I think I was quoted somewhere about saying they saw us coming. They should have seen us coming. Well, some of them did, and they lifted their standards. So that, in and of itself, is in the public interest. That having conducted that surveillance, that was a nice result, because that's the whole point. We're trying to lift standards, and we're trying to encourage people to say, well, this is good practice, this is bad practice. Now, in terms of enforcement, I don't rule out that for some of these entities, perhaps not arising out of this particular surveillance, but I don't rule it out, but there will be more additional surveillance work done. And some of the activity or practices we're seeing are rather unattractive and are close to being illegal. So if we're satisfied of that, you can expect us to take action, because I really want the sector to get the message that lift your game, or you're going to be hearing from us more and more.
Thanks.
Well, and can you allude to the practices that are bordering on illegal specifically?
Oh, they're all in the report. They're on the surveillance report. So I
assume I haven't read the whole thing.
I hate to tell you this, Tom, it's on page 3. It's okay. It's okay. It's okay. You're not an orphan. I think of all the reports attached to our media release today, I'm sure that one was the last one most people would read. But in all seriousness, it's actually a good question, because there is an existing law and ASIC guidance that we think is relevant. But I'm often pressed about this. The question of illegality and whether the conduct rises to a point where we're prepared to formally investigate it and use our formal powers and take a case to the Federal Court or Supreme Court, that's another matter. So we run about 200 investigations a year. So for serious misconduct, you can expect us to be there. Otherwise, you can expect us to have intense surveillance, more stop orders. We have an extensive toolkit, and we'll use it. Yeah.
Millie Morrow from the SMH and the Age.
Hi, Mr Longo. Thank you so much for your address. Millie Morrow from the Sydney Morning Herald and the Age. You've talked about Australia potentially facing a Minsky moment with a market collapse. What would such a Minsky moment in private credit do to superannuation funds, and are you satisfied that super funds in Australia that have invested heavily in private credit have taken enough precautions?
Well, I'm not saying we're going to have a Minsky moment anytime soon, but there is a risk of a Minsky moment. What is a Minsky moment? The idea is that we go through a period of relative calm. people think everything's fine, everything's stable, there's stable returns, people are making money, and that tends to lead to riskier activity, to more leverage, and then things suddenly go wrong. And so the background of the Minsky moment is it's my favourite footnote in the speech. You'll see it in the footnote. But I'm not suggesting for a second that we're facing one right now. But I fear that the Minsky moment may arise if we don't have all the data and transparency we need to head it off. At the moment, the private credit sector is relatively small. It's around 200 billion. In the US, by the way, it's 2 trillion, just to give you some idea. It's just amazing. But even for me to say 200 billion, I was saying to someone earlier, that's a little bit of a guess. It could be much, much bigger. And so part of my concern is we're shining a light on this. We're getting cooperation from the market in the work we're doing. I'm optimistic about standards going up. But the last thing we need, history tells us when things go wrong, everyone is surprised. We need to have systems and data gathering and transparency that just minimises the risk, that at least we have some chance of predicting when things are going wrong. But that's what that's all about.
And are you confident that super funds in Australia are sort of doing enough, the ones that have invested quite heavily in private credit?
Yeah, I'm not so worried about the super funds in this respect. They have their own, quite sophisticated risk management and investment operation. I think the issues facing superannuation are much broader. Member services, what to do with investing their assets. They're running out of investable assets in Australia. Where do they go? There are a range of other issues. But the only other thing I would say about superannuation, it's I allude to it in the speech, is that we need to be paying attention to our superannuation funds. It's not because they're behaving poorly. That's sort of missing the point. We need to be paying attention to them because of their fundamental significance to the economy. They're over 4 trillion now. Within the next 10 years, they'll be 8 trillion. And they're driving capital flows through our economy. That's very unusual. Not too many countries. We have a lot to be proud of with super, but we cannot be complacent about the running of our superannuation funds.
Thank you.
Yeah.
On the private capital aspect of the potential Minsky moment you spoke about, so assuming that the amount gets bigger, what about it concerns you? What do you want to know? Where do you want to lift the bonnet to get
well,
it?
At the moment, there's one of the reports we published this morning is by EY Pantheon, and it's a really good report. It talks about the target zone. It's a really helpful graph that diagrammatically spells out where we're an international outlier in terms of... So a good example is wholesale funds aren't required to be registered with us. There's a whole lot of activity going on out there we're just not aware of. Now, I know we're going through a period which I absolutely support and led of regulatory simplification. And nobody wants more regulation. Everybody knows that too much regulation has a chilling effect on the economy. But the regulation we do have still has a purpose to serve. And if this regulation is not working, we get rid of it. But occasionally we need new rules and reform to support an activity we do want to encourage, and in this case, private credit. So it's sort of being nuanced and sophisticated and mature about what needs to be done to encourage what we want, discourage what we don't want.
And to borrow the sort of saying from up the hill here, the net impact would be less regulation, even if some elements would have some more. Is that fair to say?
Well, there's a lot of talk about regulation, but the reality is we're not very good at measuring the beneficial impacts of changes to regulation. We all sort of instinctively feel that the cumulative effect of the regulatory frameworks that we have in our daily lives sound too burdensome. But how we go about reducing that and how we measure and where do we start and how do we measure which reforms are going to have the biggest impact, that's the big public policy question. No one's really cracked that. So we've done some, all the regulators in Australia have done some work with this, with the Treasurer's Office. We've tried to figure out, well, if we do this, will it have a beneficial impact? So, for example, file fewer forms or make the forms easier to read, or in ASIC's case, finding the statutory instruments on the website would be a pretty good start. So there are lots of things that are actually quite straightforward that we're in our gift to do now, but they do require commitment and investment in technology systems and processes, which is another subject.
But you mentioned the Treasurer's Office, there's intent there. You get a good reception when you start talking about...
Well, the Treasurer wrote to all of us, and there are a series of roundtables. I won't go over all of that. It's all very public. There's no doubt that the government and Treasury are very focused on these issues. But ASIC will play its humble role, Tom. Yeah.
No doubt. Remember, you're outgoing, so you can be very honest today. Jacob Steinman, not that you're not being. Jacob Steinman from AAP.
Hi, Mr. Longo. Thanks for your address. Jacob Steinman from AAP. You mentioned, obviously the issues at the ASX and, the impact that's having on IPOs. I just wanted to ask, how much of a setback is CIBO, planning to sell their Australian arm in that, that goal of providing a bit more competition in listings, and would you have to, I guess, reassess their licence depending on who a potential eventual
ASX or CIBO?
Oh, CIBOs, yeah.
Well, CIBO started working with us to apply for their licence last year. It took a while to get to the position where we gave them their market operation licence early in October, and towards the end of that process there was a change of leadership at CIBO, and they did a global strategic review. So I think my first point is Australia's not being picked on, So you've got Australia, Canada, Japan so far, where CIBO have made a fundamental commercial decision that the focus of their business has changed, and they want to reinvest elsewhere. So, and they've made that very clear publicly that they regard Australia as being a good place to do business. I'm rather optimistic that now that CIBO have made that decision, their decision to make, that there will be a successful sale process, which has only barely begun. It'll take time. I think that the fact that they have this licence makes the sale of the business, I think, more attractive, because any buyer won't have to get the licence. They'll need our approval, I hasten to add, but a serious buyer of this business will find it attractive that CIBO has this licence, and I've made it very clear publicly that we'll do whatever we reasonably can to be facilitative and supportive of the process. But in the end, ASIC will make a decision in the public interest as to whether or not to approve whoever CIBO decide to sell to. But we're at this is going to take time.
Next question, Corey McLeod.
Hello, thank you for your address. Corey McLeod from innovationoz.com. I wanted to ask about, you've mapped out a lot of directed energy towards getting the settings right to really facilitate the innovation you're talking about, and that there's a moment that Australia can grasp. I feel like we hear that across lots of different sectors, whether it's healthcare, etc. We get lots of great ingredients, but we don't drive it home. From a cultural perspective, what's going to need to change outside of, say, the fintechs? Where are the people and the culture that will drive through this change and make the most of all the work that's gone into getting the settings right?
Well, as far as cultural considerations go, if you step back, that's everybody's public and private sector. I think one of the things that I feel very strongly about is the need for us as a society to take science a lot more seriously, whether it's science in the boardroom or science in regulators, just science in general. So I think if you're talking about culture, a fundamental curiosity around science and technology, and we're seeing some of that mixed feelings around AI, for example. We've been doing some work there, and the recent surveys show Australians don't trust AI. In fact, levels of trust are going down. And of course, many Australian businesses are investing in AI, including the big banks, where we want them to, for all sorts of reasons. So I think the cultural factor, I would say, open, to science. As far as what I'm getting at in the speech, in the legal framework and law reform, I think as a society, we need to figure out what problems do we really want to solve and prioritise them. And that's a matter for government. It's a matter for all of us. It's a matter for regulators and government working together and figuring out what do we really want. That's one of the reasons I support the reinvigoration of a group like CAMAC, because I think government, a whole of government and regulators need all help we can get to figure out what issues require attention and that you should give priority to, because we all know government has a lot of issues to deal with and they can't all be solved at once. We need to prioritise.
Thank you.
Julie Hare.
Thank you for your speech. Julie Hare, I'm a director here at the club. So you've spoken a lot about the growth in the private credit sector and that ASIC has basically put them on notice and told them to lift their game. Could you please itemise for us in the room and who are watching on television what you consider to be the most concerning consumer harming practices that you see in the private credit sector and what your message is to actors in that area?
Well, the consumers are indirectly affected. A lot of people have access to private credit, like tradies, people in the construction industry where they can't get finance elsewhere. So to that extent, the private credit is providing a service. We're not saying private credit is bad. Private credit done well is good. The issue, though, is if there's a poor disclosure of fees, conflicts of interest, then matters of that nature, they're all enumerated in the material we published this morning, then that's going to lead to bad outcomes for investors and consumers. But it's very important to sort of start at the beginning, that when you really step back, if you want to borrow money in Australia, you can go to a bank or you can go to private credit. In fact, that's one of the definitions of private credit. It's non-bank finance. So it's a broad church. So I'm not... I think the work we've done is intended to shine a light on this sector, not because we don't have faith in its future, but because we want it to have a future. And if it doesn't do these things, then we're not going to get the benefits in the economy.
Thank you.
John Keogh from the AFR.
Thank you, Chairman. How much of a slowdown do you think is required to potentially stop or make people think when they're considering switching superannuation funds to some of these things that might be being hawked around? Is there a sort of role for regulation in doing that? And is there a risk on the flip side of that actually that might be used as a barrier to entry by big existing funds to stop their members switching to other competitors or indeed self-managed funds?
Yeah. Well, this has to be thought through. I mean, introducing frictions into the super switching process is something that I'm sure the superannuation sector, is open to dealing with. No one wants to preside over a problem like this if there are some potential solutions. So I think there's going to require some engagement with the sector as to what the practical solutions might be. And secondly, the frictions may not be for every transfer. So if you're transferring your money from one safe place to another, then that's fine. I think the remedy we're looking for, or the issue we're trying to deal with, is people sending their money to odd places. Still within regulated super space, ironically, but sending their money to entirely different space and very quickly. And remember, that often involves lead generators and financial advisors. So there's no silver bullet here. I think the idea of slowing things down at the beginning, I'll call it like a cooling off, is to help people sort of step back and say, well, I can't actually move this money for 3 days. Well, that's 3 days. They've got to get a second opinion, have second thoughts. It's as practical as that, because some of the misconduct, as I said earlier, is it all happens very quickly. So anything that just sort of slows people down, makes them think, sleep on it. We all know from life experience that slow things down, you give yourself a better chance of making a wiser decision. Yeah.
Is there a missing education aspect? I must admit I'm a sucker for a financial crime podcast, and when it comes from Bernie Madoff to Melissa Caddick, if it's a guarantee of 10% plus every year, that's a pretty easy red flag. Is that something missing from?
I think this is an issue that our society has had for many, many years. The question of financial literacy and what we do about it, it's a big subject, Tom. I think from ASIC's perspective, we run a very successful website called Money Smart, and we get a lot of positive feedback about, gets about 10 million hits a year. It's a very useful place to go. People find it very helpful with their superannuation, mortgage calculators, matters of that nature. But I think as a generalisation, I know from my own family life and just general life that a lot of people don't really understand superannuation or don't understand basic financial issues. And I think it's an issue that needs attention. But this is an issue that we've been grappling with as a society, and not just us, by the way. Internationally, the International Organisation of Securities Commissions that we're a member of has a whole committee that does nothing else. There's a global push about how do you raise financial literacy awareness. This is a very common problem.
More of it in schools. There's been a big push for that.
Oh, there's all sorts of potential remedies. And one obvious place perhaps to start is to look at school curricula. But there are a whole lot of factors that go into the way people think. So if you go into, we've got an economist in the room here, and Danny Ogg can explain this better than I can. But there are all sorts of factors that go into the way people assess risk, and it's not rational. There are lots of literature on that. So very often people don't know how to assess risk. And that's true in general life as well as in financial decisions. Yeah.
Jack Quayle.
Thank you very much, Mr. Longo. Jack Quayle from The Australian again. I just wanted to ask about the WiseTech's subject is the subject of an ASIC probe, obviously, at the moment. Should Richard White, in your view, remain executive chairman while ASIC is investigating for insider trading?
Yeah, I'm not talking about particular cases today.
Okay.
Nice try, though.
Thank you. Cheers.
Jacob Steinman.
Thanks again, Mr. Longo. You've got about 6 or 7 months left in the job, so it's probably a bit premature to start referring to you in the past tense. But when you look back on your reign at ASIC,
you mean Joe who?
I guess you've done quite a lot of work in these big projects like private and public markets work, the digital transformation at ASIC. Is there anything that you wish you had a bit more time to work on?
Yeah. Well, I think when we first started, when Sarah Court and I started on the same day, I think we inherited an organisation that had some challenges, and that took a while to work through. So I suppose with hindsight, it would have been good if we could have pulled off the reorganisation of the agency a little bit more quickly. I mean, we got there in the end, but I would have liked for that to have happened more quickly. But in the last 2.5 years, I really feel as if the agency has begun to achieve what I felt I wanted for it, and that was for the ASIC people here. They're going to roll their eyes because I say it every day of the week: to be modern, confident, and ambitious. That's what a modern regulator should be: modern, confident, ambitious. And the proof points for that, from my perspective, is that we've doubled the number of investigations. We're in court every day of the week. We are the most active law enforcement agency in the country. We're in the federal court every day of the week. We're in the state Supreme Courts. We're in the High Court at least 2 or 3 times a year. We're in magistrates' courts running cases of a summary nature. So our ASIC is on the case on the enforcement side. And my personal view is that the one supports the other. So on the regulatory side, we've done some amazing work on hardship, some landmark work holding the banks accountable on hardship. We've done some landmark work around scams. The capital markets work that we've been doing the last 12 months, I'm really very proud of. The amount of work that's gone into that work is amazing. And I know it's having impact, one, because of the feedback we get. But as I mentioned earlier, I was in the US and Europe in the last month or so, And people are asking me questions about the work we're doing, you know. And so there's no doubt that's having impact. And the other part about ASIC that I really want to is that we need to be on the front foot. And so if there are issues around regulatory complexity, we need to call it out. We need to do our part to deal with it. And so the other piece of work that I hope will continue as well as the capital markets work, and this, by the way, doesn't require law reform, is getting our own act together. We're modernising our website, reducing the number of forms, finding those statutory instruments, rewriting them when we do something about regulatory guidance. People like our regulatory guidance, but they tend to be senior lawyers, you know. So everyone else finds them a bit hard to read. And so so there's a lot of work a good regulator can do to be modern, confident, ambitious, and I think that work needs to continue. So I think they're the sorts of things on my mind. And and then I'll finish giving examples. We got the registries back just over a year ago. Feels much longer. But some of you might remember the Modern Business Register program. Everything went to the ATO, came back to ASIC last year. And so an enormous amount of work is going on to stabilise and modernise our professional and business registers, which matter to everybody, you know, to every small business in the country. So I think the ASIC of today is very different to the ASIC of 4 years ago.
A couple of mentions of the website. Can't you just tell someone to give it a makeover? What's the...
Tom, you know
the Bureau
what?
made it harder, maybe?
You know, I tried that. It's actually more complicated than you think. But we've got some very clever, dedicated people at ASIC who, without additional funding, have performed miracles on our website. But if you really want ASIC to go all the way, we need funding for our digital transformation, which I've been banging on about for 4 years. So that will come as no surprise to Treasury or government.
All right, that's clear enough. Corey McLeod.
Corey McLeod again. Looking back over your time, what was the single biggest challenge that you had in the role, and is it the same as what you expected when you went into it?
There were challenges at the beginning. A number of issues arising out of the immediate past of the agency. And I think we embarked on a journey looking at our culture, our governance, our systems and processes, the way in which we approached enforcement. You know, I think we were always pretty good at it, but under Sarah Court's leadership, it's been exceptional. So I think I'm proud of all of that. But there's no doubt that from the beginning there was a lot of sort of change that was required. And in saying that, I don't mean to cast aspersions on previous chairs or commissioners, but I'm just trying to be honest with you.
Thank you.
I'm getting the nod from John Keogh, who's desperate for one more.
I thought it was like one each.
Soft rules here at the club. Yes, John.
Chairman, the mark of good leadership, one aspect is preparing or tilling the ground for successes after you move on. You've just given a ringing endorsement to Sarah Court. I'm sure you've got some terrific other senior colleagues. Do you feel like that you have potentially prepared successors internally in ASIC who could step into the chair role when you do leave at the end of May?
No, I have excellent commissioners, including Sarah Court. But I think no one will be surprised to hear me say that it's a matter for the Treasurer and Treasury as to the process and decision as to who the next chair of ASIC will be. One thing you did say, John, that I would like to highlight, and that is one of the things that we've definitely done is refreshed and reinvigorated the leadership of ASIC. So we have 3 new commissioners. We have an entirely new exco, pretty much. We have a new CEO here, not so new, but pretty new. Sitting here, we have a new general counsel, a new head of HR. We made a lot of changes through the ranks of the organisation. There's a real sense of momentum. We are attracting some terrific people. Some of my top people in data analytics have doctorates, and they're keen. They're the ones talking to Pawsey, by the way. So that's the sort of regulator I want ASIC to be, on the front foot, attracting really keen, talented people, not only lawyers, but from across the spectrum of expertise that our country has.
We better get one from someone a bit closer to being able to access their super. Maurice Riley.
I'm worried.
You're not going to take that, are you?
I'm worried the board met without me the other day. Looking to the future, what are the future skills that the Commission's going? I mean, this is a changing world very rapidly, as you've outlined in your speech today. What are the sort of future talent and skills are you going to need to attract to be on top of this? And and can you compete with the private market for such talent?
We're a great place to work. We are a talent attractor. It's not just the commissioners, of course, but the senior executives, some of whom are in the room today. I mentioned Calissa because of her leadership in connection with the capital markets work. Everybody knows that you're going to make more money in the private sector. I know that. I've been in and out of the private and public sector. But people come to ASIC because we do great work and we're great people. The teams that I have the interaction with, I mean, I mentioned doctorates before. That's not unusual. Doctorates, higher degrees, science backgrounds, law, accounting, the various backgrounds. So people who come to ASIC come because they're going to get great work and work with great people and solve problems that affect everybody. And so that's why they work at ASIC. They're not there to make lots of money. That doesn't mean if you are making lots of money in the private sector that I'm holding that against you, but I'm just trying to answer your question, that's why people come to ASIC. As far as the future of ASIC is concerned, I have no doubt whatsoever it's a bright future because we have a lot of clever senior people who are leading the place. Now, as to the commissioners themselves, again, that's a matter for the Treasurer. The legislation talks about a wide variety of background, and I think that speaks for itself. One thing the legislation, I haven't got it in front of me, doesn't say, but I'm pretty sure I'm right about what I'm about to say. It doesn't mention science and data. And so I think I would encourage, by the way, encourage this with boards as well, that there needs to be some science, some respect for science and scientific expertise at the top of the house who understand data, technology, who have some sympathy for the subject. That's just a personal view. Yeah.
You've been generous with your time. Good luck for the final 6 months. I'll be keeping an eye on the website. Ladies and gentlemen, please thank Joe Longo.